Well, hello, class, and welcome to week 5 of BACC 531 Managerial Accounting. This week, we're covering two of the most important planning and control topics in managerial accounting, namely master budgeting and then flexible budgets, standard costs, and variance analysis. Together, these topics demonstrate how organizations plan for the future, allocate resources, measure performance, and continuously improve operations. Managers don't simply react to the results after the fact. They establish expectations through budgeting, comparison of actual performance to those budgeted expectations, and also the use of variance analysis in order to identify opportunities for improvement within the organization and its strategic planning process. As future managers, executives, and business leaders, as well as current managers, executives, and business leaders, recognize that understanding this planning and control cycle is essential because budgeting and performance evaluation are foundational components of the strategic decision-making process. By the end of our discussion and our examination of the content this week, you'll better understand how organizations construct and use a master budget, how flexible budgets improve performance measurement, and ultimately how standard costs and variance analysis can also help managers identify various operational strengths and weaknesses. So, why do organizations create budgets? Budgeting in many organizations is thought of as the four-letter word that's not really a four-letter word. It's that idea of something that's dreaded, something that is abusive or oppressive, or something that is just a negative thing to consider. In point of fact, that's not true. A budget, when it is well done, a budgeting process, when it's well orchestrated, can actually be an important strategic advantage for an organization for a number of different reasons. A budget is best defined as a detailed quantitative plan for acquiring and using resources over a future period. Most organizations in practice will prepare annual budgets that align with their fiscal year, although many also use rolling or continuous budgets that are updated throughout the year at periodic intervals. Budgets in practice serve two primary purposes. The first is planning. From a planning perspective, budgets help organizations to define their goals and objectives, to communicate strategic priorities, to coordinate activities across departments, to allocate their resources effectively and efficiently, to anticipate future opportunities and challenges, and also to identify operational bottlenecks before they occur. A well designed budget forces managers to think proactively rather than reactively. The second purpose behind the use of a budget is control. Budgets also serve as a vital control function and tool. Managers compare actual results against budgeted expectations to do several things. Number one is to improve efficiency. Secondly, they also use this process to improve effectiveness, to evaluate performance, to support compensation and reward systems, as well as to ensure organizational activities remain aligned with strategic objectives. Simply put, budgeting provides both a roadmap and a scorecard for organizational performance when it's well done and it's well orchestrated as a process. Participative budgeting is a particular approach to the overall budgeting process in which organizations have to determine not just who participates in developing budgets, but how they're going to participate. Participative budgeting is one particular approach that embraces the idea of everyone participating constructively in the budgeting process. Many companies rely on some combination of top down budgeting and participative budgeting. As the name implies, top down budgeting is when you essentially receive orders from the top and they go down the organization in terms of the budgeting process. Send us your proposals, we'll evaluate, or in more, I'll just say strict versions of that, here is your budget, here's what you're going to follow, and there's little involvement of those that are down the chain of command within the organization. Participative budget, in contrast, sometimes called a self imposed budget, involves managers throughout the organization being involved in the budgeting process by constructing their own budget proposals and collaborating with other managers and executives throughout the organization to review and bring that budget proposal to finality. This approach offers a number of advantages. First, frontline managers often possess better operational information than senior executives. They're more proximate to their particular department, division, or context. They often know more about it in greater detail, not to say that senior executives don't hold vitally important experience. They do, and their perspective is vital and their experience is vital. But oftentimes, managers who are frontline are more in the know when it comes to both current needs and current challenges, and they offer a significant advantage in terms of the information they can provide through a well done participative process. Secondly, participation increases commitment and accountability. When people have a say in the process, they're more likely to buy into the process, even if they have some issues or some disagreements with the final budget proposal. If they at least had a say, if they at least had a voice in the process, they're more likely to support, to buy in, and to cooperate with that process on the other side. Thirdly, employees are generally more motivated when they help establish their own performance targets. Again, when you have a voice in the process, when you have some say in the things you're going to be held accountable to, generally that helps to increase and to foster greater collaboration, greater support, and greater cooperation with those targets and with the overall objectives of the process. And then finally, budget ownership often leads to stronger execution. What people care about, they're more vested in. What people are more loyal to, they dedicate more to. If you have a budgeting process that everyone in the organization resents, you're likely to get comparatively weaker execution versus a budgeting process that engenders, fosters, and encourages a sense of ownership in the end product. However, participative budgeting, despite those notable advantages, also is not without risks. Managers may intentionally build slack into their budgets by understating revenues or by overstating expenses in order to make targets easier to achieve. If you're worried about your ability to achieve the intended goal, you simply move the goalpost and make it easier to get there. That might be in an individual manager's best interest. It is not necessarily in the organization's overall best interest. For that reason, senior management and executive management has to review and challenge budget assumptions carefully and appropriately. Doesn't mean that everything needs pushback, but if executive managers are in the know enough to recognize when a goal is not appropriately rigorous or when it's not being incrementally moved at appropriate intervals, they have both the right and the responsibility to say, hey, let's adjust this, let's modify this in this way. It's not that there's an invitation to be unreasonable. Again, the goal is a good budgeting process, a good outcome that leverages the advantages of participative budgeting. But part of achieving that good outcome is ensuring that that budget is balanced on both sides in terms of temptation and in terms of orientation. We want to ensure that we're leveraging the information and the proximity benefits of frontline management, their knowledge, their understanding, and their depth of expertise. But we also want to ensure that we are bringing their goals as much as we can into congruence, into alignment with the overall goals of the organization through the budgeting process. The master budget is the centerpiece of this budgeting process. It's essentially the organization's financial roadmap that comes as the culminating result of the overall budgeting procedures and process itself. The master budget is defined as a comprehensive collection of interrelated budgets that together create an organization's overall financial plan. Think of the master budget as a connected system that answers a series of critical management questions. Questions such as how much revenue will this organization generate? How much cash will we collect during the upcoming fiscal year? How much must we produce in order to meet our targeted objectives and needs? How much material must we purchase? What labor and overhead costs do we expect to incur? How much cash will we need to spend to acquire the necessary materials and resources? Will we need financing in order to meet these objectives? How much profit do we expect to earn over the budget period in question? What will our final position, our final, financial position look like at the end of this particular budget period? Each schedule within the master budget itself feeds information into subsequent schedules, creating an integrated planning framework on an overall basis. When it comes to creating the master budget, this is done through a series of steps, with step one constituting creation of the sales budget. The budgeting process thus begins with the sales budget because customer demand drives nearly every other organizational activity. Sales budget in practice will estimate the expected unit sales during the period, the expected selling prices that are attached to those units, and then ultimately, as a consequence, total revenue, those selling units multiplied by those selling prices. In the Royal Company example from your chapter in the reading in the chapter this week, projected sales form the foundation for every other budget that will follow, for every budgeted item. A critical companion to the sales budget is the schedule of expected cash collections. That might sound like it's the same thing, but the sales budget and the cash collections budget are two distinct pieces of the master budgeting process because oftentimes sales are made on account and they're not necessarily immediate realizations of cash. There can be a lag time between the point at which a sale is made and the point or the timing at which cash is collected. Moreover, not every individual will necessarily pay the full amount that is owed. We recognize that bad debt expense is a reality. Sometimes it's a relatively minimal reality. That's certainly what we hope, is that bad debt expense is minimized to the greatest extent possible, but it does happen, and there are periods where it may enlarge. For example, in times of, we'll just say, economic distress during an economic downturn, such as a recession, oftentimes bad debt expense will be expected to increase in periods where you have supply shocks or you have shortages with regard to certain things. Again, that can lead to, we'll just say, anomalies when it comes to cash collection for a variety of different reasons. There's a host of other things that can impact that pattern, that reality, but suffice it to say that the point at which we recognize sales, that is revenue, is not necessarily the same timing for when and how we will recognize the collection of cash. Thus, even within the budgeting process, those two things need to be tracked separately. Because many sales occur on account, thus managers must distinguish between revenue recognition and actual cash receipts. Cash flow timing matters, particularly when planning for future financing needs. The second step overall in the master budget process is the creation of the production budget. Once projected sales are known, managers determine how many units have to be produced. The production budget ensures sufficient inventory is available to satisfy customer demand while maintaining desired inventory levels. The basic formula is to calculate the required production. We take budgeted sales, we add to that desired ending inventory, and subtract beginning inventory. So, to put it differently, budgeted sales plus desired ending inventory less beginning inventory is equal to what's required for production. We take what we've got to sell, we add to that any projected ending inventory. That's the total amount we've got to have available in terms of inventory, during the period. We reduce that by any beginning inventory we've already got on hand, and the difference is how much we need to produce in order to meet our target. This calculation, in balance or in practice, balances customer service objectives with inventory management considerations. For manufacturers, the production budget itself becomes the foundation for estimating materials, labor, and overhead requirements. Step three, as we come to it in the master budgeting process, involves the creation of the direct materials budget. Managers estimate to create this component material requirements for production, desired ending material inventory, required purchases, and total material costs. This budget also supports development of the schedule of expected cash disbursements for material purchases. Notice as you examine and think through this process the interconnected nature of the budgeting process itself. Information generated in one budget step or one budget component becomes an input into subsequent steps and subsequent budgeted components. Step 4, keeping with that pattern, brings us to the direct labor budget. As you explore this, you'll see that the direct labor budget estimates labor hours required, wage rates, and uses a factor of both of those, the labor hours required multiplied by the wage rates, to determine the total labor costs. This budget helps managers to ensure adequate staffing while controlling labor expenditures. Labor planning is particularly important because labor often represents a substantial portion of total manufacturing costs. Next, we come to step 5, which is the manufacturing overhead budget. Manufacturing overhead budget estimates indirect production costs. These include variable manufacturing overhead, fixed manufacturing overhead, non-cash costs such as depreciation, and together, as these elements are synthesized through this particular budgeting step, this schedule will support product costing, cash planning, and financial statement preparation. We then come to step 6, which is dealing with the creation of the ending inventory and in selling and administrative budgets. The ending inventory or the ending finished goods inventory budget determines the value of inventory that will remain on hand at the end of the period. This information is necessary for preparing both the budgeted income statement and the budgeted balance sheet. Organizations also prepare a selling and administrative expenses budget to estimate non manufacturing costs. Those expenses typically included will be things such as variable selling cost, fixed administrative expenses, and cash and non cash expenditures related to selling, general, and administration activities. Because these costs directly affect profitability, managers have to budget and manage them carefully. We then come to step 7, which is to create the total cash budget, simply called the cash budget. One of the most important components of the master budget is the cash budget itself. Many profitable companies have experienced financial distress because they failed to manage cash effectively. In the most extreme situations, many companies have ceased to be a going concern. That is, they've went out of business, filed bankruptcy, and entered liquidation simply because they did not manage their cash well. The cash budget helps managers anticipate cash inflows and outflows, financing requirements, and also excess cash availability. The cash budget contains four distinct sections. The first deals with cash receipts. The second deals with cash disbursements. The third examines a cash excess or deficiency, the difference between receipts and disbursements. And then the final section of the cash budget deals with financing activities. Through this process, managers can identify future borrowing needs or investment opportunities before they occur based on budgeted expectations. Step 8 is then to generate from these other components the budgeted financial statements. The final outputs of the master budgeting process consist of the budgeted income statement and the budgeted balance sheet. These statements summarize the expected financial consequences of all planned organizational activities. The budgeted income statement provides an estimate of profitability, while the budgeted balance sheet projects the organization's future financial position. At this point, the overall planning process is complete. The next challenge is to determine whether actual performance matches expectations. That will bring us to the topics of Chapter 9. From budgeting to performance evaluation, we recognize there's a linkage, a natural process that extends from one to the other. Once operations begin, managers have to have tools to evaluate performance. Chapter 9 will introduce a concept called the variance analysis cycle, which involves preparing performance reports, analyzing variances, identifying root causes, taking corrective action as appropriate, and applying lessons learned to future operations. This continuous improvement process is a hallmark of effective managerial accounting systems. A traditional planning budget, often called a static budget, is prepared for a single anticipated activity level. The problem arises when actual activity differs from what was planned. Suppose a landscaping company budgeted for 500 lawns but actually serviced 550 lawns. Should higher costs automatically be viewed as poor performance? Well, not necessarily. Higher activity levels naturally generate higher variable costs. Comparing actual results at one activity level to a budget prepared for a different activity level often creates a misleading evaluation. A flexible budget is a solution that adjusts expected revenues and costs to reflect the actual activity level achieved. Unlike a static budget, a flexible budget allows managers to compare actual results against what costs should have been given actual operations. This creates an apples to apples comparison and provides a more meaningful assessment of performance. Flexible budgets are especially useful because they improve cost control, they enhance performance evaluation, they separate activity effects from management performance, and they also support better decision making in practice. Once a flexible budget has been prepared, managers compare actual results to flex budget expectations. Two important variances emerge from this process. The revenue variance is the first, which equals actual revenue less the flexible budget revenue. This variance measures whether actual revenue exceeded or fell short of expectations given actual activity levels. The spending variance, in turn, is equal to actual cost the flexible budget cost. This measures whether managers spent more or less than expected while achieving actual activity levels. These comparisons provide a clearer picture of managerial performance than static budget comparisons alone. When it comes to standard costs, flexible budgeting leads naturally to what's called standard costing. A standard cost presents or represents a benchmark or expected cost for producing a product or delivering a service. Organizations will establish standards for direct materials, including the standard quantity and the standard price of direct material. For direct labor, they will determine the standard labor hours and the standard wage rate for direct labor. And in relation to overhead, they will determine standard activity level and standard overhead rates for variable manufacturing overhead. Together, this set of standard costs, what we call standards in summary, create a standard cost card that serves as a benchmark for performance evaluation. Variance analysis compares actual performance against standard performance. In other words, it compares the actual cost in question to the standard amount we just talked about tabulating and calculating. Managers typically separate variances into two categories. Price variances measure whether the organization paid more or less than expected for inputs. Examples of this include the materials price variance, the labor rate variance, and the variable overhead rate variance. Quantity and efficiency variances measure whether more or fewer resources were used than expected. Examples include materials quantity variance, the labor efficiency variance, and the variable overhead efficiency variance, all of which you'll explore this week as well. This decomposition of variances helps managers to identify whether problems stem from input prices or resource utilization. Is it a true price variance issue or is it an efficiency issue if we have problematic variances or problematic differences from our planned achievements? When it comes to responsibility and managerial accountability, one of the most important managerial lessons that you'll explore in Chapter 9 content this week is that variances should be assigned to those who can actually influence them. For example, purchasing managers typically influence material prices. Production managers influence material usage and efficiency. Production supervisors influence labor efficiency. Multiple departments may influence overhead performance. Variance analysis should therefore be reviewed as a diagnostic and learning tool, not simply a mechanism for merely assigning blame. The goal is continuous improvement through a better decision making and operational execution approach. So, to summarize, this week's material, as you explore it, will highlight two critical managerial accounting functions: planning and control. In Chapter 8, we will examine how organizations create comprehensive master budgets that coordinate activities across enterprise and support strategic objectives, while in Chapter 9, you'll explore how flexible budgets, standard costs, and variance analysis allow managers to evaluate performance, understand operational outcomes, and improve future results. As you work through the content this week and your associated assignments, as always, if you have any questions, please reach out and let me know. You can reach me at jake.brock@ucumberlands.edu. I look forward to hearing from you and look forward to helping with any questions that you have. With that, thanks for watching and have a fantastic day and a fantastic week ahead.